Hi guys, Joshua Tharby here. Welcome back to the YouTube channel. So a lot of people have been saying, Josh, you posted all about Dubai recently. You forgot about us folk in the UK that can't move to Dubai. We've got children in school. We've still got UK companies. We're still paying tax here and we need your help, especially now that corporation tax is going up as originally planned. So originally they cut it to 19% so that the increases weren't going ahead. And then just last week, they reversed that, another U-turn. The government really don't know whether they're coming or going left or right at the minute, but as it stands at the time of this video, the corporation tax rate increase is now going ahead. So from April 2023 onwards, it will be 25%. So if you've got a limited company, as it stands at the small profits threshold, all of that's previously due to go be into place, where you had the 19% limit for the 50,000 and then the marginal relief. We've done another video on that on the YouTube. We'll put that in the comments. That is still supposed to be going ahead. Whether they change it so it's just a flat 25%, that could happen. At the minute now, Jeremy Hunt is the new Chancellor of the Exchequer. So for most people, corporation tax will be somewhere around 25%, which is quite a significant jump for many businesses. So what we're going to do in this video is talk about ways to lower the impact of this on you. So corporation tax, it applies to your taxable profits. So when you've got all of your turnover, less any expenses you've incurred, usually what's left at the bottom, less depreciation and a few kind of tax adjustments, is what is subject to tax at say 25%. So I just want to run through some of the popular expenses that are missed, or the tax reliefs that are missed, that are going to help you pay less in corporation tax. So the first one is make sure that you are taking a salary. So from next April, the best salary to take will be about £12,570 a year, roughly. And that's for you, your spouse, if they're not working or they've got their basic rate band available. And then also we want to see if you can employ any of your children. So as long as your children are over the age of 13, can you get them doing some work in the business? If you've got family members, your mother, your sister, your auntie, your uncle, anybody where actually they can do a little bit of work in the business, you can pay them a fair market salary, somewhere around that 12,570 mark that we just mentioned. That's going to be a great way to try and get as much wealth out of the company and also as much off of the profits of the company as well, which will lower the impact of that corporation tax rise. The next option to run through is company cars. So a lot of people still have cars in their own name, they're paying for them personally, but you're using them for business purposes. So if you fall into this category and you are using your car for business purposes, make sure that you are claiming your mileage at least 45p a mile, and where possible, look to see if you can get a car within the company. So the two types of cars or vehicles that are tax efficient, you've still got electrics and hybrids. They are tax efficient in terms of the benefit in kind charge that applies, and also commercial vehicles as well. That's what you want to do, because you can, if you buy them, you can get capital allowances on them. If you buy work for vans, you can usually get the whole amount as a first year tax deduction. The same with electric vehicles as well. And if you lease them, for the cars, you can reclaim 50% of the VAT, and all of the lease costs are a fully tax deductible expense. And the same is true of vans, except for you get the full VAT back. Another option is to maximize the interest that you're charging on your director's loan account. So if you're in a particularly capital intensive business, such as property, and you put a lot of money into the business, actually charging interest on your director's loan account can be a great tax saving move. So typically where corporation tax was 19%, you're fully tax deductible there, any interest payments, and you would pay tax on this, whether it's tax-free in your tax-free bands or at 20% in your basic rate band. But now the corporation tax is higher than the basic rate band, effectively charging as much interest as possible where it falls into your basic rate band is a tax saving move. For every pound you charge, you'll actually be saving 5% in corporation tax, and you'll have all of that money in your director's loan account, so you can pull it out at a later date completely tax-free. And then fourth, we've got pension contributions as well. So a lot of people do ignore pension contributions still. They might not think that it applies to them, but this is a fantastic tax efficient way to build wealth outside of your business and potentially invest in property too. So if you've got a limited company, you can either set up a SAS or a SIP or just any kind of normal pension scheme. I mention those because they're the more creative ones that allow you to hold different types of assets, such as commercial property. The classic example is where you set up a SIP or a SAS, you can put cash from your current limited company You can put 40,000 a year, you can backdate that as well, so you can potentially put up to £160,000 in as a lump sum, and then you can actually use that to buy a commercial premises, which you can then rent to your business, so you receive tax relief from your profits and all of the money that's gone in to your pension scheme. And then actually you can get even more tax free, because all of the money or the rent that is paid from your UK limited company to your pension scheme, you'll get tax relief on that as well, and that's tax free in the pension. That's a fantastic way to bring those profits down, especially in one lump sum, and actually save a lot of tax in the future as well. And then lastly, we've got maximising your expenses. So just your general day-to-day expenses, can you put this through the company? So whether it's travel, whether it's training courses, whether it's international travel, visiting clients and customers, what are the options for putting this through the company? Magazines, subscriptions. This is the time to get as creative as possible and actually thinking, okay, do I have a business case for putting this through the company books rather than paying for it personally? Because that's going to do two things. The more you put through the company, the less corporation tax you'll pay. And also, the more that you put through the company, the less income tax you'll pay, because you're paying for all of these expenses with company money rather than the money that you've actually already paid tax on personally. So there's 5 ways that you can potentially look to lower your corporation tax bill, especially in light of it going to 25% from April 2023 onwards. But it's all well and good at minimizing it as much as possible, but in life, it certainly says there are 2 things that are certain: death and taxes. And for the most part, whilst you're living in the vast majority of the world, that is absolutely the case. When you are living in the UK, there's only so much you can do except for actually lose money in your business, spend it recklessly, if you don't want to pay taxes. But you don't want to do that as a business owner, because actually you need profit, and where you've got profit, for the most part, there are taxes. You could do what we've done here in terms of paying people where possible, pension contributions, and all of these kind of things to actually make sure that you're minimizing it. But even after this, if you're growing your business and making money, once you've done this, there's probably going to be some left over. And in reality, that's a good thing, because it shows that you are running a sound business and you are making money, you're cash flow positive. So what you want to do there is, if you really are fed up of paying too much in tax, look to see what overseas options there are, because it can work in many different ways. If you just want to move to a country, so I know I talk a lot about Dubai, but there are other countries available that do have fantastic schemes available, such as Portugal, Italy at the minute, Bali. There's so many countries that have great exemptions for foreign source income. So where you've got income coming from the UK to you as a resident of those countries, usually that country that you're living in will exempt that income, so it can receive tax free. So this might apply to salary payments from your company, dividend income, and any self-employment income that you've got. If you're running out of self-employed trade or doing some kind of sole trade, actually they can be exempt as well. So just because what is out there might not seem like it's the best option for you, do take advice, do explore into it further, because I know firsthand just the impact that it has in terms of paying loads of tax. So historically, before I moved to Dubai, I was paying about 50% in tax, and now I'm out here, actually that 50% has a massive impact on your lifestyle in terms of what you can afford, and actually kind of opens things up in terms of how generous you can be to friends and family, or actually you don't need to work as hard, because in the UK, if you want to earn that much money, you've got to basically work twice as hard, because you have to pay the tax man. So definitely don't rule it out, and do look into it. And as always, we're posting lots of videos on the channel around this area, UK tax, Dubai, offshore, as much as possible, because the aim of this channel is just to help you guys pay less in tax. Got any questions? Do drop them in the comments below. Otherwise, give this video a thumbs up and subscribe.